Ladies and gentlemen, welcome back to RE in Real Time, Episode 8. Here are your hosts, Forrest and Lonnie.
All right. Good morning, John. Thank you for the intro, Forrest. How you doing this morning?
I'm doing well. How are you doing? We've got a great guest this morning.
We do. Tell us all about it.
Well, Jason Osser, and he charges by the hour, so talk fast.
Oh, absolutely. Yeah. That's why we have a timer going. Yeah.
So, Jason, when I was in the Alexandria, running the Alexandria offices, I met Jason through Elizabeth O'Casey. She's an agent in our office and introduced me to Jason. And what was remarkable is Jason was interested in investing in real estate, which, of course, we're interested in investing in real estate. So he has been gracious enough to not only go to the seminars that we have, but he's and talk there. He's been to the top 100 in the company that we were previously with and spoke there. And at the end of his talk, out of the 3-day session, it was the most popular topic. And folks just love it. And it's very rare that you have somebody in Jason's position. He's written books, not only on the accounting part, but he is an expert in investing. And we'll also talk about investing in real estate with your retirement account, which is called a self-directed IRA, which Jason also does. So there's going to be a lot we're going to cover today. And Jason's always great for helping us with what to look out for in the upcoming year as it relates to taxes. Welcome, Jason. Thanks so much for being here.
Thank you, Forrest, for having me. And Lonnie, thank you very much. Appreciate this.
So, Jason, tell us, you're an accountant. You run your accounting business. You're in Alexandria, Virginia.
I'm close. I'm in Annandale, Virginia, right down the road.
Now, Annandale, is that still in Virginia?
It is.
So you come to Alexandria to assist us very frequently. So you're in Annandale, and but you also, in addition to being an accountant and helping folks out, you also specialize in real estate. Tell us a little bit about your business.
Well, my business is I'm a CPA practice. I work with a lot of business owners. I work with a lot of realtors. But from the very beginning, going back to, I think I started in 2010, I started looking at investing in real estate. And part of the reason was back in the early 2000s, 2000 to 2010, back in that time, the stock market was not doing great. And I was not thrilled the way my investments were doing, and I was working with a very good financial advisor, but I was not getting what I was hoping to be getting, and I had very limited control because the stock market does what it does. And I know a lot of people like the stock market, and I still enjoy the stock market, but I enjoy being more in control. And I found that real estate, if I understand what I'm buying in the area of town and the types of renters I could potentially get there, and understand the increase of value over time, the appreciation of the properties, and being good with numbers, being a CPA, that was more in tune with what I was doing. The other thing I was thinking is down the line, one of the most common issues as people are getting towards retirement phase is they've worked all their lives, they've built up a nice nest egg, and a lot of times it's in an IRA, it's in a 401k, it's in something like that. And then they're working with financial advisors to figure out, okay, I'm now 60 or 70 or whatever my age is. How do I withdraw so I don't run out of money? And part of the reason that I like real estate is I do a lot with self-directed IRAs. And you could use these self-directed IRAs to buy real estate. And my game plan is we own multiple properties through self-directed IRAs. So down the line, when we eventually retire, these properties will be producing enough income to support the lifestyle that we want in retirement. So as long as I do my due diligence and I have good renters and I keep the place rented, and like I said, I've been doing this for 10 years, and thank God I've actually since 2010, so more 14 years now.
And you are good with numbers.
I'm okay. I'm okay. We just round to the nearest million, but I'm okay. Yeah.
So, so that was pretty awesome because during the seminars and all that, I wanted to understand how folks that had money built into the stock market as they close in on retirement, I asked you, what's the formula that's used? And I know that this formula applies. I've read it in many other places. But you said, well, they're going to move into something more conservative because something more conservative doesn't have the big drop if they're counting on taking principal out from their investment. And by moving into something more conservative depends on how much the growth is. It may not be 7 to 10% anymore. It may be less. Inflation's 3% per year. And then you said they take from principal about 4%. Well, if it's $1 million and 4% is $40,000, it continues to reduce the principal. And I did a graph on that. And by year 26, you are into the negative.
So you're broke.
You're broke.
Yeah.
And so you just have to time your departure from the world within that 26 years.
Well, and again, that's where financial advisors really come into play. And I'm not a financial advisor, but what they do is they help you try to balance your portfolio because, like you said, if you go too conservative, right now the bank accounts are paying pretty good because of inflation, everything else. You could just stick it in a bank, you'll get 4 or 5% probably. But 3 or 4 years ago, the banks were paying under 1%. So you couldn't be that conservative and pull out money and expect not to run out. So you can't, most advisors are not going to recommend you're completely out of the market, but they're balancing it more based on your risk tolerance and your needs, which is why, for me, I just enjoy the real estate aspect from the standpoint of, I know I rent my properties. They've been rented for 14 years. I have a very low vacancy rate. I understand the income I'm producing, and also, just being in the Northern Virginia market, I mean, all across the country, there's a housing shortage right now. And rates are, rental prices have been going up across the country. And I pretty much as a standard, and it seems to be about the average in the area that I am in Northern Virginia, build in a 4% increase in rent year over year. So I know that I'm going to hopefully at least keep pace with inflation. If inflation's 3%, I'm charging 4%. We'd have property taxes, other things, of course, that have to be paid out of that increase as well.
Yeah, so it's in real estate. So in the stock market, you can't have all the information necessary with every company to understand that company enough to make the informed decision that you'd like to make. When you're evaluating real estate, you're only counting on yourself to evaluate supply and demand, how it works with rents, the rent increases, and the geographic area that you're in. And then you have the increase in value, you have the money that's coming in, and when it's in a self-directed IRA, you don't necessarily have the tax advantage. But as the money's coming in, if you do have some sort of a non-recourse loan, the principal is being paid down.
Correct.
So you have multiple advantages. And as the value continues to go up, you don't have the model where you're taking out of principal, even if it's gradually going down, it's going psychologically in the wrong direction.
Right. Well, one of the things, like when people invest in the markets, some years the market does phenomenal and you'll see it goes like this. And it's been doing that recently for many years. But also the opposite sometimes happens where it really goes the other way. And then you have to learn to be patient and tolerant and keep your money in there and wait for it to come back. And I know real estate is a very general saying because different parts of the country, real estate's very local. Generally, the real estate market has been good in the U.S. for the past several years. But again, it's a very local type of thing where the houses that we have been fortunate enough to invest in, and again, this has only been since 2010 going forward, they've appreciated each year, and I know the stock market's done well in that period also, but also we're earning positive cash flow from the rent on all these properties. So even if the real estate market is flat for several years, we're still earning a 5, 6, 7% rate of return just because we're getting rental income. So it prevents the downturns in the market. Like if you were unlucky enough to retire in the year 2000 and started pulling money out of your retirement then, between the year 2000 and 2010, the S&P 500 returned 0%, where that would really erode at a lot of people's principal. Where this is essentially rent is like a dividend that's being paid through the rental properties, where as long as I don't care, well, I do care. I like to know the value of my houses are going up, but I'm not selling them. They're long-term investments. What I'm looking at more is the positive cash flow that I'm receiving, and will I receive enough cash flow to be able to support a lifestyle in retirement?
Yeah, so it's if you're equivalent to owning stock, and the stock's paying such a dividend, doesn't really go down in value at all, or compared to real estate, not much. It continues to go up in value and continues to pay a very healthy dividend.
Right, and also the dividend will be there, assuming you always have tenants that pay rent. I mean, that's on you to do your due diligence to be sure that you're hopefully getting good tenants and you're collecting the rent. But as opposed to stock, it's up to the directors in the company if they're going to pay dividends, and those change over time.
And you have no control
Correct.
at that point. So let me ask you this. So I think it's interesting. You are a professional who you give this advice. And what I think is most interesting is that you actually do it. So you're not just giving the advice, you actually can give real life scenarios about what you've experienced since 2010. And I think that makes people much more comfortable with the process. Would you agree?
Absolutely. I always practice what I preach. So, and I mean, back to get this started, for a lot of people, this may be uncharted territories. They may have heard of it, but not really be aware of it. Like anything else, if you're going to start it, start small. I mean, the first one that I bought was a very small 400 square foot. It was actually a one bedroom and 408 square feet, believe it or not. And the whole purpose of it was just to understand how the process worked. Like it was a very inexpensive property for Northern Virginia. And I was just buying it just to kind of, it's like, okay, I've never done this before. I've heard about this. I want to see how it works. So I bought one. We held on to it for 3 or 4 years. We made a little bit of money, but the point of that was not for me to make money. It was for me to understand, how do self-directed IRAs work? What do I have to do? And then as I got more comfortable with it, I was happy to keep moving forward and buying properties that are long-term investments that we're holding on to.
Are you finding that your practice is moving more towards those types of clients in that niche because of your interest in that, or not?
Well,
or not necessarily.
My practice really mostly focuses on helping small business owners. I met Forrest. I work with a lot of real estate agents that are small business owners. They have their own businesses as realtors. They tend to be 1099s. But I work with all types of small business owners. But my niche within that, I enjoy real estate. So I have I don't do a lot of individual returns unless they also have businesses, because I feel I could offer a lot more value and insight of how to help them with their business to make better financial decisions. And we do a lot of advising and planning throughout the year with our business clients. But I do work with people who are heavily invested in real estate. I do have a handful of clients that have 6 or more rental properties, and they may be in multiple states with multiple state returns. And there's a lot of opportunities in real estate. Like, real estate's a very interesting thing. I mean, you could have long-term rentals. I have some. You could do Airbnbs. There are ways to better depreciate properties if you qualify, cost segregation studies and other things like that. So it's nice having all these tools available where we could sit down and have conversations of, what are you planning on doing with your properties, and how are you managing them, and what do you want them to be? And there's a lot of just strategies that could be used that may not be available to people that don't have real estate or don't have businesses or don't have other investments like that.
And even real estate people who invest in real estate have a different advantage than those who are not in real estate too, right?
Well, yeah, and real estate has different. Real estate is kind of its own set of rules. As far as there's a lot of work that goes into it to understand how involved are you. Is it active? Is it passive? For most people, it's a passive activity. Most people are limited based on their adjusted gross income. actually modified adjusted gross income, which for most people tends to be the same as adjusted gross income. Which, if you make under $100,000, you could deduct up to $25,000 a year of losses from a rental property or rental properties, and it phases out at $150,000. So when you start making more than $150,000, you may not get to take those deductions now, but those things you'll take down the road when you eventually sell the property, more often than not, or if your income dips.
And when we talk about self-directed IRA, a lot of folks don't know this, but inside of your retirement account, you own stock and maybe precious metals, or maybe you have it in bonds. The bottom line is you can also add real estate. Mm-hmm. So you can own real estate inside of your retirement account, your 401k, your SEP account, your Roth. You can own real estate inside of your retirement account, just like you can own other things. It's just converted into what's called a self-directed IRA. And when Jason's saying that he has multiple self-directed IRAs, he means he has multiple retirement accounts where he can now invest in real estate in addition to all of the other things we spoke about.
Correct. And one of the nice things about that is just general concept of the way that it works is instead of buying a stock, a bond, a mutual fund, whatever you might be investing in, you could buy the house down the block, across town, around the country, whatever it is. And when you buy that house, it is owned by your IRA, just like it would own the stock, the bond, or the mutual fund. And all of the rental income that comes in goes back into your retirement account. You don't touch it. It's not yours. It stays inside that retirement account. It's not taxable till you take it out, or if it's a Roth that you take it out and you want to incur the tax at that point. But it's just a very nice concept of just realizing that you could own this inside your retirement, and it pays rental income every month. So that your bank account or your balance inside that IRA increases each month. So then the question comes, what do you do with that? Well, that money that's growing inside of your IRA, right now, I have some rental properties, and because I'm earning over 5% in a bank account, I'm okay leaving it in a bank account at the moment, because I don't know, down the line I may buy another property, do other things. I want the cash liquid. But when the banks are not paying this type of return, you could reinvest that in the stock market. So I would go back and I'd go in the S&P 500 to buy some stocks that I like with that rental income until I could generate enough cash in the retirement accounts again to say, okay, I'm ready to look for another property to buy. So that's how I slowly did it, to buy 4 properties. I would just repeat that process.
So with the self-directed IRA, it gives you the option to include real estate in your portfolio, in addition to everything that you already have.
Correct.
And that option gives you a huge advantage. So if you own a property for a few years inside of your retirement account and you decide you're going to sell it, there's no tax consequence at that point in time.
Correct.
It continues to grow. And when Jason says that he's earning rental income, all of that rental income is deferring tax, as just like if stocks were being sold inside of your IRA, you wouldn't have any tax consequence until you start withdrawing it once you reach the age to withdraw. But this whole portfolio is growing inside of your retirement account, whether it be the income it's producing or the equity that it's producing.
Mm-hmm. Correct.
So it's huge. Well, that's good. So let's talk about taxes today. So we talked about real estate. You're a big. What I love about I love a lot of things about you, Jason. But what I really love about you is you understand real estate and you understand self-directed IRAs. You're open-minded to it. You do it yourself. And across the board, I would say, is it a safe statement to say that most accountants don't have the same frame of mind?
I would say that's correct.
Yeah.
I would say that's correct.
And to me, where that I believe that as professionals, we give information and let people make an informed decision. And a lot of times professionals make decisions for people and it doesn't give them the the opportunity to make the decision themselves. And what I really like about you is you give folks all the options and let them make an informed decision on their own.
Correct.
At the end of the day, it's their retirement. Their decisions are going to have consequences. They may be very favorable and they may not be very favorable, but at least it was theirs to make.
Right.
So, quick question for you. So, why doesn't every CPA or accounting professional know about this or talk about this? I'm assuming they all know about it, right?
I'd say a lot of them know about it.
Okay.
A lot of them get confused, in my opinion, in the details and in the weeds, because it's if you own a rental property outside of a retirement account, if you own just a rental property that you're buying and you're renting out with your own money that's not related to retirement, you get to deduct a lot of expenses. You get to depreciate the property. You get to do all these different things. When it's inside of a IRA, those things really don't happen because you're not paying any income on it. You're not paying any tax on that income until you take withdrawals from your IRA down the line. So because of that, they're looking at this like, well, you have all these deductions, you have depreciation, you have all these things that you're not taking. So they kind of miss the part of, but yeah, it's still a good investment because
You're not being taxed until you actually withdraw. So,
right. And I mean, because I'm buying the property now. Every year rent goes up. I mean, just cost of, not say it goes up huge, but my average goes up 4% a year. So if I'm holding on that property for 10 years, my costs are mostly fixed. I mean, the real thing that goes up is real estate taxes because as the property appreciates, the taxes go higher. So I understand part of my income, has to go to the real estate tax. But the properties that I buy through self-directed IRAs, because I'm using retirement funds, they don't have a mortgage. So the expenses for these are minimal. The real expense is some maintenance on the property and real estate taxes. So you could kind of compute what your return is. And like I said, over 10 years, most places in the country, the properties are going to appreciate nicely, but you're also getting the increase in cash flow because your rent's going up 4% a year. So they're not looking at all these numbers. They're just looking at a lot of times the standpoint of, well, you don't get to deduct depreciation. Well, and that's not the whole picture.
And just to understand, so the folks understand depreciation, the entire reason you have the write-offs and why the government allows you to depreciate a property is to save money on taxes. If you have a property in your self-directed IRA or losses, and if you have a property inside of your self-directed IRA, there's no tax consequence to save the taxes at that point in time. It allows the income to grow on a compound basis, and it allows the property value to increase, and you don't start paying taxes until you start withdrawing the money when you're of age.
Right. So the big thing with depreciation is I'm holding a cup of Starbucks coffee here, okay? Now let's say that this is a business meeting. We're here for business purposes, so I deduct this $6 cup of Starbucks coffee because
that's a good idea.
This is a business meeting. Okay.
Yeah.
So we are when I do my finances, we could say I deducted $6 for this coffee, and that's fine. But if I go out and I buy a house that's $1 million, the government does not let you take $1 million deduction this year because they realize that this cup of coffee is going to last me half an hour, but that house is going to be there for years and years and years, and it's going to produce income for years and years and years. So because of that, they're saying you have to take a proportion of that house as an expense for each year for so many years. And the government came up with tables of how long items are supposed to last before they have no value. And arbitrarily for rental real estate, for residential, they came up with 27 and a half years, for commercial 39 years, which means that if you buy $1 million property, you can't deduct $1 million this year. You'd spread it out evenly over 27 and a half years, and you'd get a deduction on that on your taxes each year.
Okay.
And so if you own it inside of your self-directed IRA, if you own inside of your 401k, your SEP account, you're not getting that depreciation because there's no tax consequence on the income you're making.
Right. So exactly. So we are. for inside an IRA, there is no tax reporting other than maybe a 5500, which I'm not going to get into. It has to do with retirement with 401k accounts. But when you have a rental property outside of an IRA, the government wants to know your rental income was this, these are what all your expenses are, and this is how much you made or lost that you would affect your taxes. Inside of an IRA, we still have to keep books and records to keep track of that information, just to show what the expenses are. But we don't fill out a tax return like that. We do at the end of the year have to determine what the fair market value is, because they want to know how much money you have in your retirement account. So at the end of each year, if you own stock, bonds, mutual funds, that's really easy. You just look at the newspaper at December 31st, it's trading at X. You get a statement from your company and it says your IRA is worth X, where here you have to have a independent valuation of these properties done at the end of every year. And it's just a reporting requirement where you're telling the government that, this is the value of my retirement account.
So you're taking, basically, if it's inside of a retirement account, you're taking the money that your rental income, you're taking the money that you're earning, and then you're able to reinvest that money that you don't have to pay taxes on. So your ability to then reinvest and continue to build a portfolio is that much more enhanced, I would think.
And that's the beauty of retirement accounts in general. I mean, It works great with real estate, but it works with everything. So if you think about that, if you put money in a 401k or in an IRA, that grows tax deferred all those years. So if you're younger and you're not retiring for another 30 years, you're not paying tax each year until you take it out, which is really one of the big advantages, and that works for real estate as well. Absolutely.
Well, that's awesome. Now, 2025 is coming right around the corner.
Yes, it is.
And every year you provide us information. And just to give folks an example of the real stuff is a certain, like, people would get Venmo. They would get paid in Venmo. And you think, hey, that's no big deal. It's an easy way to go back and forth. I don't have to go to the ATM and withdraw money and give it to my friend. Like, they're just Venmoing money back and forth. So you'd think, hey, well, there's no tax consequence there, or I'm just Venmoing money. It's just an easier way of giving folks money. And, somebody buys the pizza, everybody else Venmos the money, and that's how it works.
Right.
Well, last year you told me, and I thought this was interesting, this really perks people up. A lot of tax codes start to phase out. They what's it called? Twilight?
Yeah. Sunset.
Twilight.
Sunset.
Twilight.
Yeah.
I like Twilight.
I like that also.
I'm telling you, well, maybe that would be the change.
That's a better term.
That'd be a tax.
I like it.
That'd be 2026 tax change. And then, but you said, something? Be careful. If you're getting Venmo and it exceeds $5,000 in a year, you're likely going to have potentially some tax consequence.
Well, what it was is there's something called the gig economy that a lot of people are probably recently familiar with, where more and more people are finding additional sources of income. They may be doing Uber or this or that or something to make money. Yeah. And I mean, it originally came about from, I think, 60s or 70s, where, in New York City or the big cities, there'd be a musician playing on the corner and they'd have their hat out in the street and people would give them a few dollars, and that's literally where the word gig economy started from. But a lot of people, in today's economy are doing something to make some extra money. And one of the easy ways they're being paid is through these apps or through these Venmos. And I haven't researched, so I don't remember the exact dollar amount this year, but the complication was that when people started getting this money, the government started requiring that the financial institutions, the Venmo, the PayPals, started showing statements at the end of the year. And all that it would say is that you received so much money. Well, the basic rule for IRS is that if you received money, unless you could tell us or explain otherwise, it's taxable income.
Sure.
So a lot of times it really might be you're with three friends, you're just going out to eat and you're the only one with a credit card and everyone else Venmos you $30 to pay for the meal or whatever. Yeah. But if this happens time and time again, at the end of the year, it looks like you received a lot of income. So if you get a statement from Venmo showing that you received the income, it's important to record it. But if it's all personal expenses, it's also important that you deduct it. If you just ignore it, it's likely that you may get an unwanted letter from the IRS because in their mind, they're thinking this is income. And it may be income if it's business income, but it also may be personal things that you're doing that are not related to a business income at all.
So I use Venmo a lot. I mean, my kids, when they were in college, I was constantly sending them money by way of Venmo. People send me, reimburse for, going out or whatever. I've never received a statement. Is there like a threshold or?
There is, and they were playing with the numbers of the threshold, and I didn't look it up, so I'm not sure what it's going to be this year. But they were playing with different dollar amounts because they were trying to make it a very low dollar amount, and people were getting very upset. I think it was under $1,000, and a lot of times most people just in their daily lives.
$1,000 is nothing.
Exactly.
Yeah.
So they were working on increasing it. I mean, I think years ago, a couple of years back, it was like 20,000 maybe and 200 transactions before they started issuing these statements, but they started dropping those dollar amounts significantly. Which is why if you do get those, don't ignore them. Give them to your tax preparer just so that they know that you have these, and then discuss what it is. And if it's business related versus non, depends on how you have to handle it. And also Venmo, PayPal, I know some of those have business accounts versus personal accounts. So if you use them for both, it's advisable to get a separate business account, separate personal, to keep those transactions separate.
So if you're receiving it, it's really keep track of it.
Right. Well, but also if you're using it for business,
if you're using it for business
and you're spending it, that you want to keep track of those deductible expenses.
Yeah,
exactly.
That makes perfect sense.
Yeah.
So what else is coming up in 2025 that we need to be aware of?
Well, a lot of tax planning. One of the big things I'm speaking with a lot of we work closely with our clients this time of the year on, before the year's over, what else could you do to save for taxes? One of the big talks right now is what's going to happen in January. Are tariffs going to be what they're projected to be? And if so, are items going to be costing a lot more? So I'm having that conversation, particularly with companies that have a lot of employees, have a lot of computers. We're having those discussions of what are they projecting the prices now compared to what is it going to be next year, where I know in my practice, I was originally thinking of upgrading all of our computers at the end of next year. But based on some projections where they're saying the prices could be 30 to 50% higher next year, I'm actually looking at doing it this year instead. So
Makes
it's
sense.
just those types of considerations. And if you purchase the items and you put them in place where you're using them before the year end, they could be a deductible expense for the current year.
Okay. That's great. Good information.
Yeah.
Well, I tell you, I think we could talk to you for hours and hours. I can't believe it's already been more than 30 minutes, Jason.
Wow. Time flies.
Yeah, it really does fly. But, you have this opportunity. Is there anything that you feel like our viewers just need to know as it pertains to taxes and your business?
Particularly if you're heavy in real estate or if you're a business owner, now more than ever, it's really important to have advice to do planning. If you are only putting together a bunch of receipts and giving them to someone and just getting a tax return spit out, you likely are not maximizing the value that you could be receiving with proper tax planning. I find that to be huge. And it's not just
Good
tax
advice.
planning. I mean, obviously people always love to save money in taxes, but it's also understanding how to minimize liabilities, what type of entity structure are you set up as. And a lot of times business owners just get so busy. This is just one of those things that is not always on the top of their list. And I understand they're busy, which is why you should be working with someone, and that's what we help our clients do, so that we're looking at this throughout the year and informing you of what's going on and helping protect you.
That's great. That's a great service.
So now tell folks how they can reach you.
Absolutely.
Your information. So if somebody would like to reach out to you, speak with you, or potentially use you as a CPA, how they can get a hold of you.
Absolutely. The best way is my email. My email is Jason, Jason, at Osser, OSSER, CPA.com, and send me an email. We'll be happy to respond.
All right. Well, thank you, Jason. John, you want to take us out?
All right, and that is a wrap for episode 8 of RE in Real Time. A big thank you to our guest, Jason Osser, for sharing his expertise and helping us dive deep into the financial side of real estate. Before you go, don't forget to subscribe to RE in Real Time on your favorite podcast platforms. Hit that follow button so you never miss an episode. And if you're watching on YouTube, be sure to like, comment, and subscribe to our channel for more great content. You can also find us on Facebook. Stay connected with us there for updates and more ways to stay connected in the know about everything real estate. Thank you for tuning in, and we'll catch you next time on the next episode of RE in Real Time.
That was a human voice. That wasn't AI.
Good job. You did great.
Thank you.